Hello and welcome to the IFRS Foundation's webcast series on connectivity. We are very pleased to present this webcast, which was jointly developed by the IASB and the ISSB staff in collaboration with members of the IASB and the ISSB. We have a joint team of IASB and ISSB presenters for this series. My name is Gabriel Benedict, and I'm a part of the ISSB technical staff supporting our work on connectivity. I also work more broadly supporting the implementation of IFRS S1 and IFRS S2.
And my name is Gustavo Olinda, and I'm part of the IASB technical staff supporting our work on the maintenance and consistent application of IFRS accounting standards. More recently, I have also worked on the IASB's project on climate-related and other uncertainties in the financial statements. We will begin with the purpose of this webcast series. Connectivity is really important for the IFRS Foundation, and we have published various materials that explain how our standards facilitate connectivity in reporting, irrespective of whether they are applied together as a package or with third-party materials. The purpose of this webcast series is to zoom in on how IFRS accounting standards and IFRS sustainability disclosure standards are designed to work together as a package, and how applying them together results in complementary and connected information for capital markets. Our webcast series is split into 4 episodes. In this first episode, we will start with a theory refresher and explain how our standards are designed to work together. And then in episodes 2 to 4, we will walk you through a series of examples where we will look at the reporting outcome of applying our standards together. So as I said, beginning with episode 1, we will dive into the theory and background regarding connectivity in both IFRS accounting standards and IFRS sustainability disclosure standards.
Let's take a look at how IFRS standards are designed to provide complementary and connected information. First of all, it is important to acknowledge that the call and the need for connectivity are not new. Investors have always emphasized the need for consistency in reported information and how it supports their decision-making and inspires trust in an entity's management. The notion of connected information becomes particularly important in the current reporting landscape with the increasing prevalence of sustainability reporting alongside financial statements. It is also a particularly important topic for the IFRS Foundation, with the 2 boards setting IFRS accounting and sustainability disclosure standards. Benefits of connectivity were an important consideration when the IFRS Foundation created the ISSB to operate alongside the IASB. Stakeholders consistently highlighted the benefits to be gained from having 2 standard-setting boards within the Foundation, both focused on providing information to inform investment decisions. The demand for connectivity has also been consistently highlighted by our stakeholders in our public consultations over the last few years. We have received feedback about the importance of connectivity in the ISSB's consultation on IFRS S1 and IFRS S2 exposure drafts, and the IASB's consultation on management commentary and on its climate-related and other uncertainties in the financial statements project. The notion of connectivity is embedded in our Constitution, which sets out our ultimate goal of enabling the provision of high-quality financial information for capital markets. This requires the boards to work together to ensure their respective standards are compatible and avoid inconsistencies and conflicts. This slide shows the topics we will cover in this episode of our series. First of all, we will look at the objectives of financial statements and sustainability-related financial disclosures. Second, we will look at the shared concepts that underpin our standards, including the concept of materiality and why they are important. Then third, we will discuss the requirements in IFRS accounting and sustainability disclosure standards for connected information. And finally, we will bring it all together and look at how financial statements and sustainability-related financial disclosures provide complementary perspectives on the reporting entity. Let's start with the basics and think about what financial statements and sustainability-related financial disclosures are all about. Financial statements prepared applying IFRS accounting standards provide information about a reporting entity's assets, liabilities, equity, income, and expenses. They provide this information by recognizing those items and by providing disclosure about them. As you know, recognition of elements of financial statements is anchored in past events that give rise to present rights and obligations for the reporting entity. Then disclosure of information captures both recognized and unrecognized elements of financial statements. Information about future transactions, events, and other conditions, so-called forward-looking information, is included in financial statements only if it relates to recognized and unrecognized assets, liabilities, equity, income, and expenses, and if that information is useful to primary users in making their investment decisions. Other types of forward-looking information, such as information about management's expectations or strategy, typically is not provided in the financial statements. Now, applying IFRS sustainability disclosure standards, sustainability-related financial disclosures provide information about reporting entities' sustainability-related risks and opportunities that could reasonably be expected to affect the entity's cash flows, its access to finance or cost of capital over the short, medium, or long term. As a shorthand, we will refer to all of these as an entity's prospects. So as you can see, information about an entity's sustainability-related risks and opportunities is complementary relative to the information provided in the financial statements, and it provides a different dimension and different perspective on the entity. One looks through the lens of assets and liabilities, and the other looks through the lens of sustainability-related risks and opportunities. It is also important to note that an entity's prospects are not only affected by sustainability-related risks and opportunities arising directly from the entity's own activities, but also from its interactions throughout its value chain. Therefore, the ISSB standards also require the entity to disclose material information about sustainability-related risks and opportunities throughout its value chain. Again, this is an additional consideration that is complementary to the financial statements. In addition, the very notion of sustainability-related risks and opportunities is by its nature forward-looking. So information about sustainability-related risks and opportunities provides primary users with early indications about where the entity is heading before those risks and opportunities affect an entity's financial position, financial performance, or cash flows. So again, we can see how this provides a complementary perspective relative to information in the financial statements. However, sustainability-related risks and opportunities can also affect the entity today. They can affect an entity's business model and its strategy and its financial position, financial performance, and cash flows in the reporting period. This is one place where an overlap of information in the financial statements and sustainability-related financial disclosures can arise. As illustrated on this slide, for instance, from the requirements related to current financial effects. The diagram is not to scale, and the overlap can be bigger or smaller depending on an entity's circumstances, but this is just used to illustrate this logical relationship. What is also important is that even in the area of overlap, the information in financial statements and sustainability-related financial disclosures is not necessarily duplicative. Even in that area of overlap, those reports still provide complementary perspectives on the entity. We will illustrate this in the examples we will cover in other episodes of this webcast series.
On the previous slides, we talked about how financial statements and sustainability-related financial disclosures provide complementary pictures of a reporting entity. But now let's look at why and how our IFRS standards are connected and how they ensure a coherent and coordinated picture of a reporting entity. First of all, we have the same target audience, an entity's existing and potential investors, lenders, and other creditors, who we refer to as primary users of general-purpose financial reports. Second, we share the same language and terminology. We use the same terms when we mean the same thing, and we use different terms when we mean different things. For those familiar with IFRS accounting standards, there are familiar concepts in the ISSB standards. Notions like reasonable and supportable information, measurement uncertainty, and disclosure of significant judgments. Finally, while financial statements and sustainability-related financial disclosures provide different types of information and deal with different subject matter, the qualitative characteristics of information in both financial statements and sustainability-related financial disclosures are the same. The information needs to be useful to primary users in making investment decisions. And that means the information needs to be relevant and faithfully represent what it purports to represent, meaning it needs to be complete, neutral, and accurate in all material respects. It also needs to be comparable, understandable, timely, and verifiable to the extent possible. All these shared concepts between our standards enable a comprehensive and coherent picture to be delivered to our end customers, the primary users consuming that information. Now, when we think about qualitative characteristics of information, the concept of materiality deserves particular attention. So let's zoom into it into greater detail. The concept of materiality is aligned throughout the IFRS literature. Our conceptual framework, IFRS Accounting and Sustainability Disclosure Standards, and IFRS Management Commentary Practice Statement all use the same concept of materiality, which focuses on whether omitting, misstating, or obscuring information could reasonably be expected to influence primary users' decision-making. In all our IFRS literature, the concept of materiality is applied to information, not to items to which the information relates. In other words, the question is not whether an asset, a climate-related risk, or a governance matter is material. The question is whether and what information about that item is material. This distinction is really important. Also, in all IFRS literature, materiality judgments are entity-specific and made considering an entity's specific facts and circumstances. An entity might conclude that a piece of information that is specifically required by our standards is not material in its circumstances. And similarly, an entity might determine that a piece of information that is not specifically required by our standards is nonetheless material in its specific circumstances. And here we come to a very interesting and important consideration. Those materiality judgments are made in the context of the objective of a particular report. So in other words, information that is material for financial statements is not the same as information that is material for sustainability-related financial disclosures, and vice versa. This applies even when we talk about areas of potential overlap. The other consideration that is important when we talk about materiality is that materiality judgments are made in relation to applicable reporting requirements. To give you an example, consider an entity that incurred an impairment loss where a climate-related risk was a contributing factor. Applying IFRS accounting standards, the entity would recognize the loss and disclose that the climate-related risk was a contributing factor that resulted in the loss. However, there is no requirement to disclose exactly how much that climate factor contributed to the impairment loss. In contrast, IASB standards specifically require an entity to disclose quantitative information about current financial effects of sustainability-related risks and opportunities. There are proportionality mechanisms available in the ISSB standards, but there is a specific requirement to provide quantitative information. Here you can see how applying the same concept of materiality, but with different reporting objectives and in the context of different reporting requirements, might lead you to different conclusions for financial statements and for sustainability-related financial disclosures. Finally, we would like to highlight materials that reinforce the alignment of the concept of materiality across the IFRS literature. First, the ISSB published the educational material Sustainability-Related Risks and Opportunities and Disclosure of Material Information. This guide highlights how companies applying ISSB standards can benefit from the process they might already follow in making materiality judgments when preparing financial statements, particularly when applying IFRS accounting standards. It also sets out a process that is closely aligned with the four-step process illustrated in the IASB's IFRS Practice Statement 2, Making Materiality Judgments. And second, the IASB decided to refine the definition of material it had proposed in its Management Commentary exposure draft, so that it more closely aligns with the definitions in the conceptual framework and IFRS standards. In making this decision, IASB members commented on the importance of alignment in this concept across IFRS literature. But let's move ahead. We talked about how our shared concepts help prepare us to apply our standards together and help them to provide complementary and connected information to users. But these are not the only tools in our toolkit to support connected reporting. So Gabe, could you take us through the tools that we have in the ISSB standards?
Absolutely. ISSB standards have a conceptual foundational requirement related to connected information. Specifically, IFRS S1 requires an entity to provide information in a manner that enables investors to understand, first, connections between items to which information relates, second, connections in the information provided within sustainability-related financial disclosures, and finally, connections between information provided in sustainability-related financial disclosures and information in other general-purpose financial reports, in particular, connections with related financial statements. In addition, ISSB standards have specific requirements for connections with the financial statements. A really good example in this specific requirement to provide information about current financial effects. That is, information about how sustainability-related risks and opportunities have affected an entity's financial position, financial performance, and cash flows. In addition to these requirements, the ISSB standards also require that the sustainability-related financial disclosures are provided for the same reporting entity, with the same reporting period, and at the same time as the related financial statements. Also, when currency is used as a unit of measure, ISSB standards require that the currency is the same as the presentation currency in the related financial statements. And finally, ISSB standards require that data and assumptions used in the preparation of the sustainability-related financial disclosures are consistent to the extent possible, considering the accounting requirements, with the corresponding data and assumptions used in preparing the related financial statements. So, as you can see, we have a rich set of requirements, including foundational requirements and specific requirements, that are designed to ensure connections with the related financial statements. This is because connectivity becomes particularly important when sustainability-related financial disclosures are provided alongside the related financial statements. Finally, it is important to note that these connectivity requirements in ISSB standards are gap agnostic. In other words, they are designed to support connectivity with the related financial statements, regardless of whether those are prepared by applying IFRS accounting standards or other GAAP. However, as demonstrated in the previous slides, our standards work particularly well when applied together as a package. I'll now hand it back to Gustavo to talk about the connectivity tools and IFRS accounting standards.
Thanks, Gabe. As we have already highlighted, the notion of connectivity is not new. It has always been important to investors, although we may have referred to that basic idea using different terms, such as consistency, linkage, coherence, and other similar terms. But that idea was always there. So even though IFRS accounting standards do not have specific requirements for explaining connections and do not specifically require linkages to sustainability-related financial disclosures, they do contain general requirements that enable the provision of connected information in financial statements. For example, IFRS accounting standards require disclosure about assumptions, judgments, and other sources of estimation uncertainty. Those disclosures provide transparency and granularity that enable primary users to understand connections and evaluate the relationships between various items of information, both within financial statements and between financial statements and other sources of information. IFRS accounting standards also contain requirements for disaggregation of information. Again, disaggregated information provides granularity that enables primary users to understand and evaluate connections between items of information. Also, we have an overarching requirements in IFRS accounting standards to provide additional information if compliance with the specific requirements in the standards is insufficient to enable primary users to understand the impacts of particular transactions, other events and conditions on the entity's financial position and financial performance. The additional information provided applying these requirements might help primary users understand the effects of matters discussed in other general-purpose financial reports outside financial statements, and therefore support the provision of connected information within these reports. IFRS accounting standards also contain a general requirement for fair presentation. Fair presentation requires information that is relevant, reliable, comparable, and understandable, and that provides a faithful representation of the effects of transactions, other events, and conditions. These requirements all support the understandability of connections between items of information. And finally, similar to the requirements in the ISSB standards that Gabe just talked about, these requirements in IFRS accounting standards are framework agnostic. In other words, they apply regardless of whether an entity applies these standards together with the ISSB standards or with other frameworks. To conclude this first episode of our webcast series, let's recap the main points we discussed so far. We said that financial statements look at the entity through the lens of assets, liabilities, equity, income, and expenses. When we talked about sustainability-related financial disclosures, we are looking at the same reporting entity, and this is specifically required by the IASB standards, but we are looking at it through the lens of sustainability-related risks and opportunities. Both of these reports focus on information that is material for primary users in their investment decision-making. We also talked about how there can be an area of overlap with respect to the current financial effects of sustainability-related risks and opportunities. As illustrated in this diagram, a line item in the financial statements could be affected by a particular sustainability-related risk or opportunity. So for example, in the diagram, you can see that income is affected by opportunity B. A line item could also be affected by more than one sustainability-related risk or opportunity. So for example, in the diagram, expenses are affected by risks C and E. And finally, a sustainability-related risk or opportunity can affect several line items in the financial statements. So for example, in the diagram, risk C affects expenses and liabilities. As a final note, it's important to highlight that even in those areas of overlap, because materiality judgments are made in the context of different reporting objectives and in relation to different applicable requirements, information in financial statements and information in sustainability-related financial disclosures would not necessarily be duplicative. That information still provides complementary perspectives on the reporting entity.
With that, we've come to the end of the first episode of our webcast series on connectivity between IFRS accounting and IFRS sustainability. We hope this webcast was useful in providing a theory refresher and helping you understand how our standards are designed to work together. Thank you for joining us. We are looking forward to having you join us for our next episodes where we will walk through a series of examples that illustrate the concepts we've talked about in this first episode.